Welcome to Business Tax Planning 2022-23. My name's Janelle Bartlett and I'm the partner at Accountants to Business. This is a video update and intended for tax planning and getting ready for the end of financial year. Now today we're going to go through a list of deductions. So this is general advice only. I obviously don't know your circumstances individually and everyone's different. So it's really important that you touch base with us and just make sure that the things that we talk about are actually going to be correct for you. I'd like to start to talk about the budget measures. There's quite a lot in the budget. Not a lot to affect everybody, but we'll quickly touch on the things that I think will affect some people. The big one was the asset purchases and temporary full expensing. Now that's only available at 100% until the 30th of June 2023. I won't go through all the cut-offs because honestly for most small businesses you are able to claim 100% of most of your purchases and those large capital items, but it only applies up to the 30th of June 2023 and the items need to be purchased and installed and ready for use by the 30th of June 2023. So if you've ordered a car or some machinery and it hasn't arrived at the 30th of June 2023, you're out of luck. Now to qualify, your turnover needs to be under $50 million. It does apply to second-hand assets, also to improvements on assets, so things where you've added a part to it or modified something. Motor vehicles that are over the 60,741, motor vehicles are claimed up to 60,741. The excess cannot be claimed. The private portion can't be claimed, and that kind of depends on how we deal with private portions. If you're a company and you pay fringe benefits tax on the private portion of your vehicle, then the whole vehicle is claimed for a tax deduction again up to that 60,741. Capital works don't qualify, so that's the building, the parts of the fit out of your office or the building part of a factory. And assets not in Australia don't qualify as well. Some primary production expenses don't qualify as well. Of course, non-business things, private things don't qualify. Now this is going to substantially change from the 1st of July. The limit will be from the 1st of July $20,000. Now that's probably a bit of an improvement because we thought that it might go back down to $1,000 once the temporary full expensing measures expired on the 30th of June. So assets that over $20,000 will be claimed in the old way, which was 15% for the first year and 30% for the years after that. Now they're only available to small business, and this is a previous problem with some of the previous provisions. If you operate a hire company or a service entity where you have assets in one structure and you're leasing them out to another structure, you may not qualify as a small business and you won't be able to claim up to $20,000. You'll simply use a pool, which is the 15% and the 30%. We have to look at it sort of case by case. Definitely people with trusts and partnerships and sole traders that own assets and lease them out to a business have a problem. Companies have a lesser problem, but it's certainly still there and we need to assess that for you. I want to look at some of the budget announcements. Here we've got some of the sundry budget announcements. So the build to rent announcement, I know a lot of people are excited about this, but it's actually going to be quite difficult to claim it. So build to rent will apply when you build 50 or more apartments, and the capital works claim will increase from 2.5% to 4%. You need to hold the asset for 10 years and the structure that it's held in is important. So it doesn't look like much, 2.5% to 4%, but the cost of these buildings are huge and it does actually add up to that. These are going to be quite significant builders and investors that use these provisions. Another announcement is the Clean Buildings announcement, and you could apply that to your office building. Even some of our clients have small shopping centres and warehouses. So you do need a 6-star energy rating, which is pretty difficult to get in those sorts of buildings, but if that appeals to you, there's some incentives for that. The pay-as-you-go instalment applies to many clients. There was an uplift factor last year of 12%, and I know that was very difficult for some clients. It's quite a lot. And for the 23-24 year, that uplift factor is going to be 6%, which is still high, but a bit more manageable. There's also a small business energy incentive, which is a different thing to the clean building. This is for upgrades to generate and store electricity. It's for expenditure up to $100,000 with a maximum tax deduction of $20,000. There's a proposal also to have super paid on payday. So some of us use a automatic super, which is in the software, particularly in Xero, where you can sort of one click and pay the super to the various funds. It sometimes goes wrong because one staff member might change their super fund and the whole thing goes awry. But from the 1st of July 2026, the proposal is that we don't pay super quarterly, that we pay super as we pay the wages. Now, the budget announcement around electric vehicles, it was really just the costing of all of that. It wasn't any change in the previous announcements. The legislation went through in December last year and it really hasn't changed. So essentially an electric vehicle, and for a little while some hybrids, are going to qualify to be FBT free. They must be under the luxury car limit. So there's two limits relating to cars. One is the luxury car limit, and above that limit you pay a luxury car tax, and that limit is $71,849 for the 2023 year. Now, you really want to make sure that the vehicle is below that, and just be careful of extras. So, adding tinting and leather seats and all of that, electric seats might put you over that luxury limit. Once you go over that luxury car limit, the dealer will have to add the luxury car tax, and your car is out. It's no longer FBT free. The other thing is that the depreciation limit still applies. So $64,741 is at the moment. So if you buy a car that's, say, $70,000, you're only able to depreciate it up to $64,741. If you're lucky enough to have that delivered before the 30th of June, you're going to get an instant asset write-off for $64,741 or up to that. And it can be completely private vehicles. So if you've got a company and you want to buy a vehicle for someone that really doesn't have any business travel, this is ideal, assuming you don't mind electric vehicles, because it's completely FBT free. It means you get 100% tax deduction for all the fuel, registration, insurance, repairs, and the depreciation up to the normal limit. This wasn't actually an announcement about the Export Market Development Grant. It was just sort of the absence of any information. It looks like it's going to phase out. So it hasn't been replaced or hasn't been refreshed. So it looks like the Export Market Development Grant might just lapse. So the people that are on it now will continue to get their grant until their projects are finished. But it looks to me as though that will not continue. The Medicare levy threshold is lower. This only affects people on quite low incomes, so it just means that you can earn a little bit more before you have to pay Medicare levy, both as a single and a family, and there are the rates. It really won't apply to many of us. There's pretty controversial announcement about increased tax for super funds. Again, it's a proposal. It's not law. None of these proposals are law until they actually go through both houses of Parliament. So these are just things the government wants to do. It's almost like a policy announcement. So they're looking at members' balances over $3 million. I believe I read in the media that about 80,000 Australians would be affected by this, and they would increase the tax from 15% to 30%. Now, I believe I've also heard some commentary around the fact that it will only apply to super balances that are not in pension mode. And that makes sense because the super balances that are in pension mode actually have zero tax. So that makes sense to me. But again, we won't know for sure until the legislation is through, and it won't affect a lot of clients. One thing that it is a huge change, and again, this is a policy announcement more than anything in the budget, is the proposal to tax super funds on unrealised gains. That's a massive change to our tax system. Our tax system is based on paying tax when we sell a capital asset. So if you own a property, if you own some shares, and it increases in value by $100,000, you don't pay any tax until you sell it. And that's a sort of a cornerstone to our tax system. So to make this proposal that super funds would pay tax on unrealised gains is really quite extraordinary. And I can tell you if that gets up, it will apply to a lot more than super funds. That will be the start. It will continue through. There are some jurisdictions in Europe that have this. They're not very popular, I can say. It can lead to some cash flow difficulties. You can imagine being taxed on a gain that you actually haven't received in cash. So I'm not keen, and I'm quite sure there's a lot of people not keen. I think they would have a lot of trouble getting that through both houses of Parliament. Now, they're going to put significant funding into the ATO and to tax compliance, particularly non-lodgers. So during COVID, they just completely stopped chasing non-lodgers. They understood that some people just did not have the money to have the tax work done and to pay the tax. So they've kind of left everyone alone. They've been a little more active in the last sort of 6 months, but this is a warning that they're going to be much more active. Now, they're saying that they will remit failure to lodge penalties up until December 2023. So that's a real incentive. If you've got outstanding lodgements, I really recommend that you go ahead and get those done before December 2023. I don't think they will remit interest, but the penalties are a huge part of it, so a great thing to avoid if we can. Now, just getting back to general things that we should remember every year. So business travel. So if you pay now for your business travel that you're going to do later, you can receive a tax deduction for it. So paying for that before 30 June is a tax deduction now. And just remembering that travel under 6 days, you don't need a travel diary, but it does have to pass the smell test. So, if you're a hairdresser and you go to Uluru for 5 days, it's probably not business. So just be careful with it. Don't get too carried away. That's when it looks unusual and looks like it's not the pattern of your normal business and shows that it's probably not actually business related. So make sure it is business related. Under 6 diaries, you don't have to document what you're doing every day. 6 days and over, you actually have to document a travel diary, and you need to work sort of 4 to 6 hours a day to make sure that you can show that it is a business trip. Some things you can pay in advance. You can pay up to 13 months in advance. So in June, you can pay the next year's rent, and that can bring forward a deduction. But of course, what that does is it leaves you a bit short of deductions next year. Interest you can also pay in advance, but it is going to the bank and asking them to change your loan, and that can be expensive, of course, and just simply paying more on the loan is of course paying more into the principal, so it's not paying more of the interest. So be a little bit careful of that. Interest is more difficult to do with this. Rent is quite easy, so you can go ahead and do that. I don't know a landlord who won't take that. Also, if you have stock, and look at what's obsolete and write it off. So we do that when you do a stock take. So do your stock take, and that's one of the things that'll be a reminder as well. Do your stock take, and you're noting the cost value of all of your stock. Also on that same schedule, make sure that you note which stock is obsolete, and we can actually write off that obsolete stock. Bad debts are pretty important. You need to have taken reasonable steps to recover it, but if you've done that, you can write off your bad debts. So if you've got bad debts in your accounts receivable, where you're just not able to get the money out of your customers, and you have genuinely tried, you can write those amounts off. So trying doesn't mean turn phone calls. It doesn't necessarily mean legal action either. If you talk to your lawyer or to your collections agent and you determine that the amount of the debt isn't worth the cost of recovering, or that your position is unlikely to be successful, then you've taken reasonable steps and you can write it off. Don't go through and just write off things that are a bit old. Make sure that you have taken those steps. And it does need to be written off before the end of June. So make sure that the write-off is dated the 30th of June and that you've at least minuted or made some decision to write them off before the 30th of June. Purchase deductible clothing, protective clothing and qualifying uniforms before the 30th of June. Don't buy things you don't need, of course, and the same with tools and all of those sorts of things. Bring forward expenditure that you might have been looking at in July, August, September. Bring that forward, but don't buy things that you don't need. If you've got $100 and you spend that on something you don't need, you've wasted $100. If you keep it and the ATO takes 30% as tax, at least you get to keep $70. But if you needed the uniform, go ahead and buy that now. It's a good time to pay FBT exempt gifts to staff. So if you do end of year thank yous, now is the time to do it, and do it before the end of the 30th of June. These gifts need to be under $300 and infrequent, and just make sure they're not entertainment. So they can't be movie vouchers or restaurant vouchers. They need to be things like a Coles Myer voucher, an Officeworks voucher, boating, camping, fishing. Those sorts of things are really good. It can be a pure indulgence voucher or a massage, believe it or not. Can't be a gym though. And pay staff bonuses before the 30th of June. Just note your pay dates. Nicely, the 30th of June this year falls on a Friday, so that's sort of happy days for accountants, because the things that you want to put through in that pay run that encompasses the 30th of June is likely to cut off on that Friday, and try and make sure it does. So if your pay run is a fortnightly pay run and it goes into the next week, you need to make sure that those bonuses are paid in the previous pay run so that it's picked up and paid before the end of June, so you get the deduction. Now, donations to charities, the charities won't let you forget, but obviously just those charities that you might have, make sure that those donations are made before the 30th of June. Just a note on wages to spouse and children, they must be commercial rates, and for actual time worked, you can't just pay them because it's a better tax plan to pay them. They need to have actually completed the work. But so I sometimes see people who pay their wife and children more than would be reasonable, but I equally see people where the spouse and the children are actually working in the business and they're not being paid a wage, and they really should be. It might be that they're on a marginal rate which is 0, and you might be on a 40% marginal rate, so you're actually going to save that 40% in tax. So it is a good idea where it's appropriate. Staff use super, pay that before the 25th of June. That quarterly super payment is quite large. Some people like to pay it monthly and more often in any case, but if you pay that quarterly, just pay the June quarter on the 21st of June. Now you can pay it up to the last pay run that you ran, so that you've just got 1 week or 1 fortnight falling into the next year, but you're going to bring forward a large deduction that would otherwise fall in the following year. Now, super contributions, if you wanted to top up your super, the maximum claim is $27,500, and that does include your super guarantee. So don't put the $27,500 on top of the super that comes with your wage. It has to be the total, has to be under that. Now, if your super balance is under $500,000, you can actually bring forward any contribution gaps that you've not claimed. So last year, if you claimed less than $27,500, you can bring into this year that loss, that gap. And it goes back a few years. So now the ATO publishes those amounts for each taxpayer. So if you want to know what your amount is, let us know and we will look that up for you for clients. It might also be available on your MyGov account. Now on June 30, there are quite a few things to remember to do, and we'll just go through those now. So one of them is a stock take. So you need to know the value of your stock at cost at the 30th of June, and that's if you've got stock on hand. It also includes things like if you've got a workshop or your oils and spare parts and those sorts of things. If you've got a shop, it includes your packaging and your stock. So just think about the sort of stock that you might have on hand and make sure you do a count of that on the 30th of June. You also need to record the odometer reading on your motor vehicle if you claim that motor vehicle on a logbook basis. So commercial vehicles like utes that you're not using a logbook for, you don't need to do this. Commercial vehicles where you are using a logbook, you do need to do it, and other like normal sedans and things, you always need to record your odometer reading. Now the manual logbooks have a spot in the front where you can record that each year, and the digital ones also have somewhere on the app where you can record that. Now, if you want some help to remember so basically your stock take and your odometer reading, either pop it into the reminders on your phone so it pops up like mine does, or let me know, and we have a free SMS reminder service to remind you of things, and we can pop you on that for both stock take and or recording your odometer. Okay, there's so much more to do, and this sort of goes into end-of-year planning as well. Essentially, if you've got a trust, we really need to do your trust distribution minute. Now, if you are a BAS client, we'll be working that out for you. We will work out our suggested trust distribution. We'll talk to you about that. We'll prepare the minutes and get that out to you before the end of June. Similarly, if you come in for tax planning, we will do that, all of that as well. If you are a taxpayer that doesn't see us for tax planning, just sees us once a year for tax, we'll send you a pro forma so you can complete it. Now, company tax is something else to consider. We need to get an idea of what that will be. Again, if you're a BAS client, we will be calculating that for you as part of that service and inviting you in for interim meetings to discuss the things that we can do. If you ask for the tax planning service, we can do those calculations for you as well. Apart from that, if you're operating a company, just have a look at your profits and make sure you've got a handle on that. Dividends are very important as well. The dividend resolution must be written and signed and dated before the end of June. So again, tax planning and BAS clients, we will be doing that for you, and just making sure that we get that great balance between using your franking account imputation credits and looking at your other income and tax rate. Division 7A loans must be attended to before the end of June, and with our FBT work we've been doing that, and again we'll be looking at that at tax planning time for everyone. Asset protection, it's a good time to look at asset protection and see if there's something that we can do better. We can use trusts, or if we can just simply make sure that some assets are being accumulated by certain taxpayers. Another note, just to remember that a lot of clients don't seem to remember, is that substantiation is really important. So when you're making a tax claim for a deduction, you need the invoice and the receipt, but you also need proof of payment. So when the ATO comes along to audit you, they will want to see preferably a digital version of your invoice, but they also want to see proof of payment. So they need to see the entry where you've paid that on a bank statement or a credit card account. Now, one other thing we need to think about, there's a provision in the Tax Act called Part 4A, and it essentially says that if you enter into an arrangement and the only reason that you enter into that arrangement is to save tax, then it's illegal and you can't claim the tax deduction. So, I mean, it sort of sounds strange, because you would think you'd be able to manage your tax much like you manage, your fuel bill and everything else, but you really can't. It's actually quite illegal to do something only to save tax. It cannot be a dominant purpose. So you might enter into something for asset protection. That's not the dominant purpose for tax savings. So to do that is okay under tax law. However, it might put you into trouble with trustees if you end up insolvent. So you've just got to be very careful about why you do things. The main thing is really don't go into kind of contrived and complicated plans. I mean, they always come unstuck. They're expensive to administer, and generally the people that put you into those are, their main interest is the earned fees and just trying to continue to generate them. Okay, so if you like the video, subscribe to our YouTube channel, and also drop us a note if there's anything that we can help you with, and don't forget tax planning is super important. Thank you.